Hey investing friends, I'm Mr. Financial, and in today's video, I'll go through 7 stocks I bought in March and share the reason why I added 1 new position. Let's do this! Before we look at what stocks we bought, I'm starting a new segment called Market Flash where I share my take on what's been happening in the market using readily available statistics. If this is your cup of tea, give this video a like and subscribe so you don't miss next month's segment. The month of March was a continuation of the bull market. As of March 31st, the S&P 500 is up 47% from its October 2022 lows and 11% year to date. The Nasdaq Composite is roaring ahead even more so, up 59% from its October lows and 11% year to date. Even the TSX Composite here in Canada is up 19% since its lows and nearly 4% year to date. Here's my market outlook. Take it with a grain of salt, as I'm sure you do. I'm just another dude in Vancouver, Canada with his personal take on market conditions. The US economy has proven to be more resilient than initially thought, with strong GDP growth at 3.3% in Q4 2023, and the employment numbers are still looking good. Unemployment came in at 3.8%. Inflation is remaining elevated. March CPI coming in at 3.5% resulted in the Fed returning to the dovish stance and pushing the higher for longer verbiage all over again. Markets had expected rate cuts starting spring, with 3 or 4 cuts priced in. It isn't as rosy up north. Canada's inflation is slightly less at 2.9% in March. However, GDP growth is stalling even with the mass amount of immigration we have, finishing Q4 at 0.2% growth. Because of the mass immigration, unemployment is now at 6.1%, up 30 basis points from the previous month in spite of employment increasing. I believe this will force the hand of the Bank of Canada to lower rates before the US, resulting in a weaker Canadian dollar. This could lead to more inflation and bad news for many interest rate sensitive sectors in Canada, and rates to possibly go back up. Of course, everyone under the sun is speculating, and I could be completely wrong. Now for the 7 stocks we bought in March. First, we added to our Fortis position. It is a steady eddy in our portfolio, has 50 years of continuous dividend growth, is averaging a 5.8% CAGR over the past 5 years on its dividend, is trading 20% below its 5-year average yield, and has capital plans totaling $25 billion from 2024 to 2028. We dripped 1 share of Fortis at $51.46 with the 2% discount. This added $2.36 to our annual dividend income at a yield of 4.6%. Next is another drip with RioCan Real Estate Investment Trust. REITs are beaten up right now, and RioCan is no different, trading at an attractive price to FFO of 10 times. As of its Q4 2023 report, FFO per unit is said to be within the range of $1.79 to $1.82 for 2024. I like its growth profile. It recently raised its distribution 2.8%, the 3rd year in a row. It has a modest payout ratio of 59%, over 98% occupancy in its retail portfolio, and many projects in the pipeline. We dripped 3 shares at an average cost of $18.30. That added $3.33 to our annual dividend income at a yield of 6.1%. The other rate suffering under the current market conditions we added to is Smartcentres Real Estate Investment Trust. It finished 2023 with 98.5% occupancy and FFO of $2.23, an increase of nearly 8% from 2022. In my opinion, this isn't trading as deeply valued as RioCan, but may be better priced soon as the real estate market in Canada continues to suffer. I am comfortable accumulating during these difficult times and waiting for the recovery. We added 9.4 shares at an average price of $22.70. This added $17.44 to our annual dividend income at a yield of 8.1%. Guys, one way to turbocharge your Tfsa returns is by getting some free cash from promos like moomoo sign-up bonus. Use my link below to set up an account before April 30th and deposit just $100 and you'll get anywhere from $30 to $200 depending on your luck. You can get up to $2,400 in cash rewards. Next, we have another sector in the doghouse that we nibbled at, telecoms. BCE Inc. has been suffering during this interest rate environment. It raised its dividend 3.1% despite its lackluster financials. I'm still not too worried about its dividend coverage despite all the negative talk on socials, especially after it shut down some non-profitable media outlets, the Source stores, and its plans for 4,700 more layoffs, or about 10% of its workforce. It is now trading 40% below its 5-year dividend average. I do not believe it will recover until it can show solid cash flow growth and a stabilization of its balance sheet, which may take a few years. We nibbled 5.6 shares at an average price of $44.99. That added $22.24 to our annual dividend income at a yield of 8.9%. Man, that's crazy to even say. We also added to Telus. It is in a slightly better position than BCE financially and has also done some cost-cutting measures themselves. Over 6,000 jobs to be more precise, that should start to show some results. Telus plans to grow its free cash flow from $1.8 billion to $2.3 billion this year. Telus has a ridiculous yield of 6.4% in March. With 20 years of dividend increases, a 6.7% 5-year CAGR on its dividend, and it's trading 30% above its average yield. We added 11.5 shares at an average cost of $22.99. This added $17.33 to our annual dividend income at a yield of 6.5%. Now for the two positions we really added to and are both in the same industry. First, let's look at First National Financial. The numbers really speak for themselves. Just look at their track record. Not to mention some milestones they hit in 2023. Revenue continues to climb, net income per common share increased 27%, MUA are growing steadily at over 5% a year. There are a lot of headwinds in the Canadian real estate market, and the share price is reflecting that. First National recently raised its dividend 2.1% and issued a 75% special dividend in November. It has a 12-year dividend growth streak and a 5.3% 5-year CAGR on its dividend. We added 37.1 shares at an average price of $37.16. This added $90.86 to our annual dividend income at a yield of 6.6%. And lastly, our new addition is MCAN Financial. Why do I like MCAN as a mortgage investment corporation in our Tfsa? As an MIC, it has to pay out all of its earnings pre-tax. Since we hold this in our Tfsa, it increases our return because it's completely tax-free earnings as opposed to interest income, which is taxed at the marginal rate. MICs do have specific regulations, and MCAN carries risks, including the risk of default on the mortgages in its portfolio, interest rate risk, and market risk. MCAN has a 5.1% CAGR on its dividend the past 5 years, has grown its dividend 8 times in the last 10 years, and just raised its dividend 5.4%. And it continues to grow its diversified portfolio. If you'd like to know my thesis on MCAN Financial, mention it in the comments below. We bought 89 shares at an average price of $15.89. That added $138.84 to our annual dividend income at a yield of 9.9%. So there you have it, the 7 stocks we bought in March. We deployed a total of $3,610, adding $292.40 to our annual dividend income at a sky-high yield of 8.1%, thanks to MCAN. I'll be watching the markets like a hawk with about $50,000 in Tfsa contribution room to go and retirement in sight. Thank you so much for watching. Alla prossima. Until next time.